Assalamualaikum, Board of Members and Board of Directors. We are from Group 4 Financial Department. We present a comparative analysis of the financial performance of two companies that we select, which is Lei Hong BHD versus QL Resources Berhad. That will be considered for the company's strategic investment. So before we start, we will present our name first. My name is Muhammad Asif Haikal. My number metric is 1232758.
And my name is Muhammad Azrail bin Muzani, and my number metric is 1232735.
My name is Muhammad Hilmi bin Rafi'i, and my number metric is 1232729.
And my name is Muhammad Faiz Izzahan bin Rosli. My metric number is 1232748.
So, to the highlight, we will go through to the introduction, and then we will go through the financial analysis ratio. And based on the ratio, we will make a SWOT analysis and recommendation. And after that, last but not least, we will do the conclusion for the finance performance. First thing first, let's go talk about how and why we choose the company. They both are actually listed on Bursa Malaysia and based on Sharia compliance and principle. The most important is they both are in the same industry, which is consumer product and service. And let's go about why we choose the company. First, for the reason they both are in the same industry, which is food producing. Lei Hong established in 1980 with a primary focus on poultry farming, egg production, and processed foods, which is significantly similar with QL Resources Berhad. In addition, both companies have extra benefit to be a good reason why we really want to compare their finance performance. For Lei Hong Berhad, they have benefit with strategically partner with the overseas industry, which can strengthen their domestic operation. And then for the QL Resources, recently, it is now an agri-food company with various segments including marine food, palm oil, and retail such as Family Mart. So let's go through about other sections. Now let's start with liquidity ratio first. First, we have current ratio, which is current asset divided by current liability. As a result, we calculate QL Resources Berhad has a higher ratio than Lei Hong Berhad that suggests a more conservative liquidity position. However, both companies have a good condition due to above 1.0 ratio, and as long as the liability are not growing faster than assets. Next, we go through the quick ratio, which is current asset minus inventories and then divide by current liabilities. After removing inventories, Lei Hong still has 0.85 in high liquid or asset test ratio for every 1 ringgit of short-term liabilities, while QL Resources has 1.67 ringgit in liquid asset per 1 ringgit of liabilities. So, based on the current ratio and quick ratio, QL Resources Berhad has better short-term liquidity and has the stronger liquidity position than Lei Hong Berhad, even when inventory are excluded. QL Resources Berhad is in a better short-term financial position and more capable of paying off its current liability quickly even without selling inventory.
We move to another section, which is efficiency ratio. This section contains 4 parts. Firstly, inventory turnover. Lei Hong Berhad sell and replace their inventory 6 times per year, while QL Resources Berhad sell and replace inventory 5 times per year. It shows that Lei Hong Berhad has super efficient in terms of inventory management, fast sale, restock of the inventory, and enhancing overall operational efficiency instead of QL Resources Berhad. Next, average collection period. Lei Hong Berhad takes around 43 days on average to collect cash from their debtors, while QL Resources Berhad collect payment faster than Lei Hong Berhad within 28 days. QL Resources Berhad stricter in monitoring receivable collection process. Thirdly, the fixed asset turnover. For Lei Hong, every RM1 of fixed asset, they generate RM1.64 in sale, while QL Resources Berhad are more efficient because they generate 2.27 per RM1 of fixed asset. And lastly, total asset turnover. For Lei Hong Berhad, the total asset turnover is 0.99. This means that for every RM1 of asset, the company generates 0.99 in sales. It shows average efficiency. For QL Resources Berhad, The ratio is higher at 1.21. This means QL generate RM1.21 ringgit in sale for every RM1 ringgit of assets. So QL is using its asset more efficiently compared to the Lei Hong.
Now, leverage ratio. This section contains 3 parts. First, debt to equity ratio. This means that for every 1 ringgit of shareholders' equity, Lei Hong has 0.5 cent of debt, while QL Resource has 0.71 of debt. Second, debt ratio. In terms of the debt ratio, Lei Hong has 46% of its total asset funded by liability, while QL Resource is slightly lower at 42%. Lastly, the interest coverage ratio. Lei Hong can cover its interest expense 10.74 times with its earning before interest tax, while QL Resource can cover its interest expense 9.57 times with interest before earning before interest tax. Both Lei Hong and QL Resource has similar financial leverage, which is debt to equity ratio of 0.85 and 0.711 respectively. Shows that a balanced use of debt compared to shareholders' equity. Then their debt ratio also shows that half of their total assets are financed by liability and indicate the reflecting a moderate level of financial risk. However, Lei Hong has better ability to handle debt cost with an interest coverage ratio of 10.74 compared to QL, which is 9.57. Thus, it means Lei Hong can slightly cover its interest expense more than 10.74 times with its earning, showing that Lei Hong Berhad significantly stronger debt servicing capacity.
Okay, so now we go to the net financial analysis ratio, which is profitability ratio. And the first is gross profit margin. So for the first gross profit margin, Lei Hong making 25 and 28 cent gross profit for every 1 ringgit of sale, while QL Resources BHD making 22.96 cent gross profit for every RM 1 ringgit of sale. So for QL Resources BHD earn more profit from its sale after covering production cost. It has a better cost structure or higher markup. So we go to the next, which is net profit margin. And for Lei Hong BHD, we got 0.46%, and QL Resources Berhad we got 0.42%. So we can describe that Lei Hong is a little bit more profitable than QL Resources, which is keep more or each RM in revenue profit. And the third one is return on asset. So we got for Lei Hong BHD, which is 10.74, and QL Resources Berhad is 9.57. So both company use its asset efficiently to generate profit. Okay, next we go to the return on equity, which is Lei Hong Berhad get 16%, while QL Resources Berhad get 15%. So Lei Hong use its asset more efficiently to generate profit, even the difference only 1%. So next, for operating profit margin, Lei Hong Berhad get 13%, while QL Resources Berhad get 10%. So Lei Hong has better operational efficiency, earning more profit from its core business. So from all the profitability ratios, we can conclude that Lei Hong Malaysia clearly outperform QL Resources Berhad in all profitability indicator. For the result, Lei Hong BHD achieved a little bit higher gross profit margin, which is 25.28% versus 22.96%, such as a better control over cost of goods sold. Also, the net profit margin is stronger 9% compared to QL Resources Berhad, which is 8%. So it's showing it retain more profit from revenue. In terms of return, Lehong Berhad and QR Resources Berhad both same 9% return on asset, which is ROA, while Lehong Berhad got 16% return on equity ROI, and QR Resources both asset and equity to generate profit. Further, the operating profit margin of Lehong Berhad is 13 instead of 10% for QR Resources Berhad, which confirms superior operational performance. Hence, Lehong Berhad was more profitable and efficient.
Now we go through the CCC, which is cash conversion cycle. What is CCC? CCC is measure how long it takes a company to convert investment in inventory and operating cost into cash from sales. Alright, at the chart we can see that CCC for QR Resources is higher than Lehong. It doesn't mean it's better performance. In case at this point CCC from Lehong BHD show that the company takes to convert its investment inventory and other resources into cash flow from sales more than 10 days than QL Resources. Well, this is strong sign of cash flow efficiency that can allow QL Resources to manage the working capital efficiently.
Okay, now I will present the SWOT analysis for the Lehong Berhad. Firstly, Lehong has several financial strengths. It recorded a high gross profit margin of 25.28% and a net profit margin of 9%. It's showing that the company is profitable and can control its expense well. It also has a high inventory turnover of 6.19, which indicate good stock management. In addition, the interest coverage ratio is 10.774, meaning the company is able to pay off its interest obligation comfortably. And lastly, its operation profit margin of 30% shows that its core business operations are performingly strong. However, there are few weaknesses of this company, which is the current and the quick ratio are quite low, which suggests that a company may face some short-term liquidity issues. Also, the cash conversion cycle is 44.49, meaning it takes longer for the company to turn its investment in inventory into cash. Furthermore, Lehong is slightly more dependent on debt financing with a debt to equity ratio of 0.85. There are also promising opportunities. The demand for halal poultry and processed food is increasing both in Malaysia and in regional market. Besides that, Lehong's expansion through online shopping and its collaboration with NH Food Japan give it a room to grow its customer base and revenue. And lastly, the company faced a few threats. The main competitor, which is QR Resources, create strong pressure in the market. Also, raw material and feed costs can fluctuate, which might impact the profits. And since the company is in poultry farming, disease outbreak could pose into serious risk to operation. Thank you.
Okay, I will now present the SWOT analysis for QR Resource Berhad based on our financial and strategic review. Firstly, let's look at the strength. QR Resource shows strong liquidity with a current ratio of 2.08 and a quick ratio of 1.67. This means the company is in a good position to cover its short-term liabilities. It also has a fast receivable collection period of around 39 days and a cash conversion period of less than 55 days, supporting a stable cash flow. In terms of operation, QL uses its fixed and total asset efficiently and earns income from various sources including Family Mart Retail, marine product and palm oil. Moving on to weakness, despite its size and diversification, QF profit margin are slightly lower than Lehong. Also, it has a lower inventory turnover ratio of 5.57, mainly due to its large palm oil stock. This indicates room for improvement in inventory management. Furthermore, its cash conversion cycle is relatively high, suggesting that account payable and inventory turnover can still be optimized. Now for the opportunities. QL has good potential, has good future potential. The expansion of Family Mart promise consistent revenue growth. There are also rising demand for agri-food products in Southeast Asia, and QL could benefit by diversifying export and strengthening its sustainability blending. Lastly, the threat. QL faces risks such as volatile palm oil price and environmental concern, especially for palm oil operation. It also bears the complexity of managing highly diversified business and face strong competition from more focused players like Lehong.
Okay, next we go to the recommendation for improvement for company Lehong Berhad. So, Lehong should improve its liquidity by better managing short-term debt and increasing its cash reserve for ensure it can meet financial obligation and handle unexpected challenges. To speed up its cash flow, the company should shorten its cash conversion cycle by negotiating better credit terms with supplier and improving the collection of payment from customer. Additionally, Lehong boosts its sales and operational efficiency by expressing into digital and export market while also up. Okay, so we go to the QR Resources Berhad. So, for recommendation for improvement, QR Resources Berhad should improve inventory turnover by strengthening demand forecasting and making its supply chain more efficient. It should also review its costs, especially the cost of goods sold, and adjust pricing to increase profit. The company is encouraged to keep investing in the Family Mart retail chain and adopt the sustainable practices to meet future market environmental trends. Lastly, QL should continue to manage its debt carefully to maintain its strong financial position and low risk profile. Okay, now we go to the last of our analysis, which is conclusion. So for opinion and ability to grow, so for Lehong demonstrate stronger performance in profitability ratios, particularly in terms of net profit margin and overall efficiency. On the other hand, QR Resources excel in liquidity asset utilization and receivable management, indicating better short-term financial health and operational control. Both companies show potential for expansion within their respective sector. However, QR Resources possess a greater capacity for long-term growth and is better positioned to withstand economic fluctuation. So, for the recommendation to board director, QR Resources Berhad is well suited for long-term investment due to its strong liquidity position, diversified business segment, and consistent financial performance. In contrast, if the primary focus is on short-term profit and operational efficiency, Lehong Berhad may be a suitable choice as it offers better profit margin and leaner operation.